kick off this webinar. First of all, thank you so much for joining our webinar on sustainable investing and ESG funds. My name is Gina Buchholz. I'm one of the advisors at 401k Plan Professionals, and along with my team members, Kristen Carlin, Jessica Ballin, Jenna Witherby, and Kelly Panic, I want to thank you for joining us today. If you've joined some of our webinars in the past, you know these are typically about 30 minutes or less. Today's webinar will be about 30 minutes, and we'll definitely leave some time at the end for Q&A. As with all of our webinars, there will be a recorded link that will be shared with you in a week or two. You're welcome to share that with your colleagues, staff, or anyone who you think might be interested in this topic. And of course, you can find all of our past webinars on our website at 401kplanprofessionals.com. I'm particularly excited about this webinar on ESG investing. We get a number of questions about ESG investing, especially lately, as I think corporations, organizations are looking to, a diversity and inclusion policy. We have plan sponsors asking us if ESG investing is appropriate for their 401k platform. And we actually have a lot of plan participants, especially the younger demographic, asking, can I have ESG funds in my 401k? So it is a hot topic, and I'm so thrilled to offer two amazing guest speakers from Fidelity Investments. Let me introduce them. Our first speaker, Yasmin Landy. She is an investment portfolio manager at Fidelity Investments. She has been with Fidelity since 2006. And she also serves as a member on their investment management team. So she has a deep knowledge of portfolio philosophy, investment construction, and one of her special focuses is on ESG investing. She holds a degree from Lehigh University and also a master's degree from Columbia University, and she's also a CFA charter holder. And along with her colleague, Dan Tremblay, they're going to tag team this presentation today. So I think you'll find great perspective from both of them. Dan is also an institutional portfolio manager at Fidelity Investments. He spends a lot of his time working with institutional clients, developing investment solutions for them. And he also has a particular specialization in ESG investing as well. He holds a degree from Northeastern University, and he's also a CFA charter holder. So these two have an enormous background perspective to share with you today, specifically on ESG investing. So I'm going to first turn it over to Dan to kick off the presentation. Thanks, Dan.
Sure. Well, thank you, Gina, and thank you, everyone, for having us today. What I'm going to do is kick things off with some industry trends that we're seeing across Fidelity out in the marketplace, and then we'll double click a few of these topics and dig a little deeper throughout the discussion. But if you think about ESG, right, we've all seen the client demand surveys, the consultant studies highlighting exponential AUM growth, the Wall Street Journal articles on climate change, right? This is more than just a trend. It's fundamentally changing the way companies run their businesses, and it's changing how we invest. And so what is ESG investing? Well, it's the belief that companies who do a better job managing their sustainability of their business, whether it's the environmental, social, or governance considerations, will lead to superior risk-adjusted performance over the long term, while also having a positive impact in the planet and the society. So a hopeful big win-win. However, I think it should be clear that ESG is not the only risk factor driving investments, but I think as more and more investors embrace ESG, it's a risk factor that has to be a component of the broader investment mosaic. And Yasmin's going to expand on some of these points in a moment. But if we think about ESG, it is a little unique in the fact that it impacts all asset classes, all client types, and it's evolving quickly. When we look at some of our institutional clients, they're very focused on ESG ratings, which we'll talk about, investment process and performance impact. When we deal with some of our retail clients, it's more focused on impact reporting, right? Are my dollars making a difference? Show me how they're impacting the climate, the broader globe. For the 401k investors, I know close to many of you participants, It's the regulatory oversight, right? The DOL and SEC, and what they're doing is they focus on this, and I'll expand on that in a moment. But also we should think about, how do I evaluate ESG options? How do I know if someone's doing a good job? So we'll expand on some of those points. And then finally, as we think about the different client types, our friends in Europe are several years ahead of us. I think it's a good indication of what's coming here to the US, and some of the things that we're seeing: better data disclosure, strong demand, lots of AUM growth. In addition, if anyone caught the IPCC assessment report on climate change that drove all those scary headlines a few weeks ago, it's a clear game changer, in my opinion, right? The impact on the climate is undebatable, and I think it's now in the front seat. It's a mainstream issue. And the cost to slow down this climate damage is measured in trillions of dollars of CapEx per year. So this is going to create tremendous investment opportunities for investors. We're also finding that people are in education mode. Just like this, we seem to do a handful of these each week with all different types of sophisticated investors. And I think the issue is we all need to speak the ESG language, whether we're making dedicated ESG investments or not, right? It's going to impact every investment that we make one way or the other. Just today, our bond president was giving us an update, and he mentioned a Casey Quirk study that shows ESG assets are going to go from 2.8 trillion today to 13 trillion by 25. Now, I don't know about the exact magnitude, but I think it's clear that ESG needs to be in your daily lexicon. Another interesting point, speaking to these trends, RFP questions used to be just 1 or 2 questions on 1 or 2 products. We're now seeing them on all products, over a dozen questions, getting into lots of details. On the regulatory environment, which I know is a very important issue for this audience, I think that it continues to evolve. We're seeing more oversight, more transparency demanded, more consistency. And as Yasmin and I were talking yesterday, these are all good things for investors in a new investment frontier. So a little more specifically, and certainly we don't have a crystal ball, but we're following these as closely as you are. The SEC, what are they looking for? They want more consistent disclosure and transparency so investors can make informed decisions. And this requirement is going to apply to company disclosure and asset manager disclosure in their funds. And we see things evolving in Europe, and I think it's coming here to the US. And to that end, the SEC recently established a climate and ESG task force to help flesh this out. And the issue is the data is not clean. So it's a very complex issue. It's not just a lack of focus and effort, but it does impact our ability to make good investment decisions. So it has to be a major focus. When we think about the DOL, they're evolving, just as we all are as we get more comfortable. There's a little bit of politics behind this as well, I'm sure. But it has evolved from the 2020 strong stance against ESG, where we were told you only use performance-related factors, to its current stance of saying, quote unquote, we're not enforcing the ESG rule from 2020, to now expecting any month now, a more explicit comment that should further support ESG, but still making sure there's investment merit behind it, but taking some of that explicit call out of ESG off the table. So time will tell, but I think generally speaking, we're seeing a trend towards more support for ESG from the DOL. I think as the SEC does their job and demands more transparency, more consistent disclosure, all of that's going to dovetail nicely to embrace the ESG that we think can help serve investors and serve the planet well. And then finally, before I hand it to Yasmin, why don't we turn the page and just look at industry flows. And this is just capturing 40 Act, but this is also symbolic of what we'd see from separate accounts in the institutional and pension space, but I think directionally this speaks to what's going on. So you can see here, looking at quarterly flows, you can see it ramping from less than $1 billion to mid-single digits to 10 to now $20 billion run rate. And I think that trend is only going to continue. Another thing worth noting is the growth of active ESG. I think early on out of the gate, when you think about large cap growth, something that people often passively invest, It was a logical first step to check a few boxes with passive ESG, but I think we're expecting to see that active engagement continue for two reasons. Number one, as we continue to shift into more extended asset classes, such as emerging markets, small caps, high yield, investment grade bonds, I think more judgment is needed to help find these ESG winners where you can't just overweight tech and win in return and win in ESG. In addition, for all asset classes, we know that most companies aren't where they need to be today, right? Everyone's gotten the memo in the last couple of years that ESG is critical to your business. And so they all need to accelerate their ESG journey, their sustainable journey. And I think penalizing them for the past decade or even where they are today isn't going to help. But I think if we make qualitative, forward-looking assessments of where is this company going, identifying tomorrow's ESG leaders that the market doesn't realize yet, that's what's going to drive progress, and that's what's going to drive better investment performance. And that's one of the main reasons why we developed our own proprietary ratings that Yasmin's going to walk you through, where we actually take that forward-looking qualitative assessment through company engagement to have a better read on what you're doing in the future rather than just focusing on the last couple of years of what you did or didn't do. So big picture, things are moving. It's multidimensional. I think when we look at what's going on in Europe, it is coming to a theater near you, and it's more, not less. Yasmin?
Perfect. Thanks a lot, Dan, and thanks everybody for joining us today. When I reflect back on how I became interested in ESG, it dates back going probably 15 years when I was working more explicitly in emerging markets. And you could really see these factors that, ESG existed, but it wasn't as well defined. But we would see these issues crop up that had substantial material impact on the value of the business. And so a lot of the colleagues at that time in the emerging markets group, we started to think about these things and focus more. I mean, governance was a huge factor, but there were others: disasters, lack of care for safety in mines, and a lot of the areas that we were looking at in emerging markets. So my interest started there, and I became really excited where our firm started to formalize what we do in ESG. And as Dan said, this is a big industry focus. And I think part of it is that recognition that there's also value to add by looking at these factors in a formalized approach. So one of the pages that we're sharing with you here talks, I think, kind of the early days, or even sometimes what people think ESG is or sustainable investing is, and that's the negative or the exclusionary screening that we've seen. And going way back in time, I remember working on portfolios for religious organizations, typically where we would exclude things like tobacco or firearms, and that's what I think early days that we were thinking. But ESG, when we look at the middle column, the integration goes much more to that materiality factors and the value impact that you can find both on the positive side and on the value protection side. I think on the negative side, protection of capital. So when you're thinking about how you might utilize ESG, and I'm thinking about those on the call, whether it's you're interested in on a client level or for a 401k plan where there may be plan participants, employees. We definitely see it in the younger cohort who want to have those options. I think there are multiple ways that one can go about it. Dan brought up a little bit of the issue with the DOL, and I have talked to a lot of the defined contribution clients that I work with, and there's hesitancy because you don't want to be in that situation where you put something on there that's not return objective. So I think about the two ways that you can do it. A focused ESG, explicit ESG, marketed as an ESG strategy, but there are a lot of ways to do that. Dan talked a little bit about the passive opportunities that you can have where you're utilizing some sort of screening methodology and that's what you own. And then there's the more active approaches to ESG where you might start there, but you're doing more work to get into the policies, the actions, and some of the forward-looking aspects that a company may partake in various ESG segmentations. And so those are two things that you can do, but then there's one other way that you can think about ESG, and that is perhaps strategies that you are already using where the firm is integrating ESG into their approach. We're doing that at Fidelity, where we'll have strategies that we're absolutely not marketing as ESG, but it is a component in the mosaic of understanding a company more deeply. And we'll talk more about that when I go through some of the ways that we've approached internal ratings and why we think that's important. But so those are a couple of different ways that I wanted to bring up ESG in terms of the integration or a explicitly marketed ESG fund that one might use. Then lastly, thematic investing. And I think this is really interesting for several reasons. It's probably further away from a 401k lineup because the trend is really to consolidate the offerings. And so I think having a lot of thematic offerings, probably we're not going to get there unless one uses a mutual fund window or something like that. That being said, I know individuals really respond passionately to thematic investing opportunities. And we see that when we survey our clients. I work on the Women's Leadership Fund at Fidelity. Actually just finished a presentation on that strategy just before we got on with you. And there are a lot of women investors that control about half the wealth in the US that are really keen on investing with gender equality in mind. And when you go down again in the younger cohort, it's even stronger. So, that's just one example of a thematic strategy that a client could be very interested in. And then there are so many passions around the environment. We list here water, alternative energy. But the other component that I get excited about with thematic investing that impacts some of the diversified portfolios that I work with is it is great to look at in terms of an investment theme in and of itself. So whether I think about hydrogen, wind, any renewable energy, EV vehicles, and there are a lot of themes that are going to be massive, I think, in the next couple of decades. To Dan's earlier point, and we really have a big catalyst to invest in our globe, in renewables and helping our environment. So that's another way to think about ESG that's a little bit more specific to thematics. So I wanted to just spend a little bit of time using our firm as an example of what we're doing in terms of ESG. And I would, there are a number of other firms outside of Fidelity that are also embracing, utilizing, and establishing frameworks for looking at ESG. But I think this can be helpful when you're thinking through offerings that you may have with your clients or on 401k plans to think about, are the companies using this and how are they doing it? The point that Dan made earlier about the SEC, I think this is a really good and important area of focus for them because, all the work that we're doing in ESG, it needs to be robust and it needs to be utilized as well. So I think it's key to kick the tires and sort of figure out what people are really doing. So we have two ways that we're approaching it. One is the systematic ESG rating, which is more of a snapshot where we're collecting a lot of data so that we can have a very broad measurement of ESG factors across the investment universe. So for the equity space, we have about 7,000 that have ratings in the systematic. What's unique about the systematic and why it's different than say using MSCI or Sustainalytics, why we wanted to do it ourselves. One is because you really know the data and the sources of the data, and you can get under the hood and understand what the drivers are. But secondly, we spend a lot of time thinking about materiality factors. And so going with our fundamental research teams, sector by sector, to discern what factors we think in an ESG lens have true material impact on that sector. So for example, you can have a healthcare company that has the best environmental impact scores, but that might not really be the driver, but how they price drugs could be much more meaningful and have a societal impact. So that's what we did sector by sector. So broad brushstroke, but the limitation of a systematic rating is it's a point in time. So it's not really capturing the dynamic nature of companies, what they're doing going forward. So that's where the fundamental ESG rating comes in on the right-hand side. So what we're doing there is a proprietary look, focusing again on those same materiality factors by sector, where we're talking and engaging with companies and essentially scoring them to see how far along the ESG path they are. I think the engagement with the companies is really critical, because not only are we talking to them with ESG focused discrete meetings focused just on ESG, but we're also meeting with them on building models and margin structure and capital allocations. And it's the same folks, generally speaking, that will be doing that work. So it is woven together. And what I mean by that is there's some fundamental analysts that are modeling companies that are also doing ESG, both in high yield, fixed income, and equities. And then some cases we'll have our ESG team leading that effort. But it is bringing together the discussions that we have about ESG factors to the CFO, to the CEO when they come in-house. We like to see how well they know the policies as well. So the scoring is really exciting, I think, for us, because it's proprietary, it's in-house, it keeps us really close to the issues, and it's also triggering that interaction with the companies. And there are many examples that I can think of where we utilize this to understand the companies, kind of their ethos more deeply, whether it's how they're hiring, their hiring practices, their brands. When we talk to, let's say, a clothing company, we want to understand how their pollution, recycling, chemicals that are used are happening. You have industrial companies where we're taking an active role in what they disclose in terms of plastics pollution, as another example. It really runs the gamut. Safety in energy companies. So this is the work that is just part of ESG, and I think this is a good example of how at least our firm is looking at it.
Great. Maybe I'll continue the dialogue here. And so I think, as Yasmin outlined, ratings become very important components into our investment evaluation. They're not perfect, but at least it's a tangible first step to say, okay, how do we compare multiple companies across each other or within their industry to define who we think are ESG winners versus ESG laggards? So a common question that we get at this point is, well, how is it brought together, and what distinguishes a dedicated ESG fund from a traditional fund if everyone is drawing on the same ESG research? And so we put this slide together to help kind of decompose the two approaches. So typically you would want to do, if you're doing your evaluation of a manager, you want to find out what is their ESG infrastructure? How has it evolved in the last couple of years? And sure, it may be great if they did something 8 to 10 years ago, but we know the ESG today is not the same ESG of a decade ago. So really focusing on what have they done? What are they hiring? What type of resources do they have? What are they doing over the next 5 years? And what vision can you get could be more critical than what they did a decade ago. And so what we've done here is we've organized our infrastructure as a member of the UNPRI, which is a requirement to be a signature that we engage with companies. We have ESG ratings. We partner to further bring ESG into the industry lexicon. We've developed the proprietary ratings that Yasmin mentioned. So sure, we rely on third party, but we've also built our own. We have a great company engagement model where we ask all these questions in the dialogue. Is it really trickling down from company management, or is it a memo that someone read 5 minutes before the meeting? And then we have scorecards to say, all right, fund managers, how are you doing versus ESG? Because for some of us, this is a new prism to look through. It's evolving. So we're looking at how we're doing versus indices to make sure we're applying that tilt from our active engagement. So if every firm or every person at Fidelity can draw off of that infrastructure, how does it get implemented between the two fund styles? Well, you can see here on the left, for our sustainable funds, we're going to have a very clear fund objective about ESG considerations. We are going to have prohibited industries. We're still finalizing that at Fidelity, but you can guess some of the usual suspects across firearms and tobacco and things like that. And that ESG consideration is going to be very strong, driven by our ratings. And it's going to be consistently applied across all ESG funds, consistent with their objective. When you go over to the traditional funds, we're not changing that total return mandate or income or low tracking error for a passive fund. It is still the same fund objective. We're not going to prohibit any of those toxic industries. However, ESG, as we've described throughout this discussion, is going to be one of many tangible inputs where the portfolio managers are going to determine where it's material and relevant. So you can believe today, if they're investing in tobacco, they're investing in certain energy companies, they're going to be heavily influenced by that ESG research. But if for some reason there was compelling value over the short term, they could take advantage of it. So again, I think the key takeaway is they're drawing on the research, they're using it where it's relevant, and more often than not, it's becoming more and more relevant as ESG starts to impact more than just the usual tobacco and energy type sectors. And so the distinction is, one is almost strong form, the other is weak form, where the PM is dictating it. But I think the broader theme, as you think about your participants that are looking for ESG, sure, you can offer a couple of labeled ESG funds, and especially if the regulatory environment gets more supportive. But I think you can also find through your due diligence and all the questionnaires that we're getting, a lot of those RFP questions are not on dedicated funds. They're on the everyday funds and asking, how integrated is it? Give me tangible proof. And I think there's a way to demonstrate that ESG is influenced within these portfolios, even if it's not a strong form input. So I think at this point, we've wrapped up our prepared comments, but certainly welcome any Q&A, Gina, from you or any of the participants.
Yes, absolutely. And like I said, if anyone has a question, please put it in that Q&A or chat feature. I don't see any in there right now. But Dan and Yasmin, I do have a question. Obviously, as 401k advisors, we're sitting in committees with many of the plan sponsors that are on the call today, or their investment committee members. And we have talked about ESG, and we obviously can help our committee members look under the hood. Just as you said, with some of these new and more robust scoring tools. And we have had a few clients adopt ESG. But I'm just curious, do you know the statistics on how many plan sponsors are adopting ESG funds in 401k, or do you have a rough idea? And where do you see that trend going in the future?
I think Dan might actually have that number, because there's been some work that Fidelity has done on our 401k side looking at that. I can say anecdotally that when I'm in meetings with some really large corporate plans, it's really interesting, because if you think about the companies that we're interviewing and asking ESG questions of, and they're changing or focusing on these items. And then as an extension, they look at their 401k and they're sort of, we're doing this as a corporate culture, but yet it's not making it into our 401k. So I can absolutely share with you that so many of my like sort of Fortune 500 companies are asking those questions. And it's an extension. It literally feels like an extension of what they're doing as a public company entity into their 401k thinking. And actually states have been asking about it as well, because think about the states and how important a lot of these aspects are to them too. And when they're putting out business to bid, they're asking really similar questions. So it becomes like an extension. Dan, I don't know if you had any of those statistics.
Yeah, as you were answering, I just grabbed a couple of data points that I had. So I think, again, very consistent themes today. We're seeing it ramp up. It's coming off a low level. And I think, again, the regulatory environment could be that turbo boost that everyone's waiting for. But I'm looking at some data that we've collected across our broad plan lineup. And we were in the mid-teens a couple years ago, and we're ratcheting up to 20%. So again, you can see it's increasing, but a little less of a steep increase versus what we saw from some of the non-401k activity. And you have to believe that regulatory cloud is what is, kind of, again, playing that role of a cloud, right? Slowing down.
Right.
But I think what we're seeing, and this is what I would encourage everyone to do, is do your due diligence now. Because we know that, again, if I'm going to go with the weather cloud, that's probably appropriate for this conversation. The sunny days are coming where I think we all believe, although we don't have a crystal ball, that there's going to be more benign than where we are today. And so that, you don't want to be flat-footed where we know this takes time, it's complex, you're asking new questions. We all know how to go out and evaluate a core bond or a large cap value manager. We've been doing it for decades. But I think it's even understanding what are the right questions to ask. And those are some of the topics that come up in our dialogue. It's great to educate me on ESG, but help me how to ask questions and what is an important question and what is a less important question as I do this due diligence. And again, I think we shared some of that previously around the infrastructure, the resources, the commitment from senior management. It's not whether you've launched 10 products and some will launch 5. At the end of the day, there aren't going to be 75 dedicated ESG products. Most of this growth is going to come from just ESG integration into traditional asset classes. And so I think that's where you just want to make sure the infrastructure is there to support that.
And Dan, if I can just add on a little bit, as I was thinking about the expansion in Fortune 500 companies that are thinking about these things, and then why not bring it into the 401k plan. I think it's also important when you're lifting up the hood and looking at firms, how they're doing ESG is also what they do as a firm themselves. And I know we've been spending a lot of time talking about what we're doing in each of those pillars as a firm ourselves. So it's just another point.
Yeah, but I think we should not confuse low adoption with low interest, right? I think that as we're seeing everywhere else, the interest has grown exponentially. The verbal interest is high in the DC world, but I think people are still just waiting for that regulatory green light to embrace it further.
I agree 100%. And, as advisors who sit as fiduciaries on, our clients' investment committees, I can say we are having these conversations today. As you said, it's, to your point, it's important to start having the conversation today. And it's also important, we've been documenting those conversations in our minutes, even if it's a conversation at very high level. But, Yasmin, you mentioned, how does this align with their corporate mission of diversity and inclusion? We want to note that in our minutes have some documentation that we are at least talking about it. And so, yeah, I agree with you. The conversations are out there. We'll continue to have them, continue to document them. And I think as this evolves and the regulatory environment becomes a little more clear, we'll see more. We'll have more of these conversations and better mechanisms to monitor. So let's see. I don't see any Q&A from the audience. So I am just going to wrap up here. Yasmin and Dan, again, thank you so much. You are definitely experts in this field. We appreciate Fidelity's support from you and the entire Fidelity team. And I also just want to mention too, speaking of investment committee meetings, we are offering our next quarterly fiduciary training on November 18th. You can always reach out to our team if you have questions. If I don't know the answer on ESG, I can reach out to Yasmin and Dan for more specifics and a deeper dive into any questions or thoughts you might have. But thank you very much from our team to the Fidelity team and to all of our audience attendees today. We certainly appreciate it.